Good afternoon, everyone. Thank you all for being here. We call this meeting to order. No need for a roll call. The chair will mark everyone present. I'm South Carolina Representative Carl Anderson, and I will be chairing this meeting today. Let's give our CIO a round of applause, Mr. Tom. Y'all didn't do what I said. Let's give our CIO a round of applause. Yeah. Let us pray. O thou in whose presence our soul takes delight, a watchman in the day and the night, thank you, God, for bringing us to this place, and thank you for traveling grace and mercy. And we pray now that you would be with us as we go through this meeting and the days ahead. Amen. I now ask for a motion to waive the quorum requirement. So moved and second. Thank you very kindly. Now I ask for a motion to approve the July 21st, 2023 meeting minutes. All right, so moved and second. All in favor signify by saying aye. Aye. Those who oppose the vote nay. The ayes have it, and so it's ordered. Before we get started with our agenda, I'd like to note that starting with this conference, we are introducing a new testimony process. Anyone in the audience who's not scheduled to speak on an issue can fill out a testimony slip stating who they are representing and what their position is on an issue. The testimony slips can be found on the speaker table. After completing the slip, you can submit the slip to me or whoever is staffing the committee next to me, and then it will be incorporated into the minutes after the meeting. You can feel free to submit a slip on any issue. It doesn't necessarily have to be a model law or resolution. So with that being said, we will start today with an update on the NCOR Life Insurance is a Promise for Life Model Act. This will be a very brief update as the sponsor of the model, Indiana Senator Travis Holdman, wasn't able to be here today. You can view the model on page 114 in your binders and on the website and app. Senator Holdman did ask me to report to everyone that since he was not able to be here today, and since there has still been significant regulatory developments on this issue among the states, he would like the model to be held at this meeting, and he would like to see how things develop over the next few months before deciding what the next step is to take with this model. It may end up being that such regulatory activity reaches a level that makes the model unnecessary, and states that are interested in responding to this issue can utilize the resolution that NCOR adopted on this issue as a guidance. We did have a couple of speakers scheduled to make brief comments, but in light of some last-minute scheduling changes and the model being held, they have withdrawn requests to speak. So if there are any questions on this issue, please reach out to Senator Holdman, myself, or the NCOR staff. Next on our agenda is a discussion on the return of the U.S. DOL fiduciary rule. As many of you know, the U.S. DOL has been working on this rule for nearly a decade, and despite a prior version being vacated by the courts, the DOL is back at it again with a second bite at the apple. In your binder on page 117 is a resolution I sponsored that was adopted at our last meeting, which opposes the return of this fiduciary act, a rule. And on page 119 is a similar resolution that was adopted back in 2016. Lastly, on page 121 is a statement from NCAL CEO Tom Considine regarding the DOL's latest action. As you can see from both resolutions and the statement, the main issue here is that there simply isn't a need for federal involvement in this area of revising professional responsibilities for financial professionals providing investment advice. That area is reserved for the states. And under the proven state-based insurance, legislative, and regulatory structure, tens of millions of Americans have been able to receive sound retirement assistance, products, and services from financial professionals who have consistently served the best interests of the consumers. I'll stop there, as I don't want to take up any more time from our speakers. Joining us today are Allison of Groom Law Group, Brian Graff of the American Retirement Association, and Lee Walters, Senior Vice President of State Relations at the American Council of Life Insurance. We will hold any questions until everyone is finished. Please go ahead, Ms. Allison.
Thank you, Mr. Chair. I feel like you took my speech and already did it, but I'll go ahead anyway. The Federal Department of Labor is racing through a rule-making effort in the next weeks that will shape the behavior of insurance companies and insurance agents that's currently under your regulation in a profound way. The DOL is reviving its 2016 rulemaking to capture more sales activity while providing itself with the ability to prevent a company from doing business for a full 10 years. The activity that was highlighted in the rollout was the sale of annuities portrayed as containing junk fees. This rulemaking explicitly rejects your efforts to regulate using a suitability best interest standard for annuities sold to retirement investors as falling short of the protection that DOL wishes to provide. Good afternoon. My name is Allison Atami, and I'm a principal at Groom Law Group Chartered. It's a boutique law firm focusing on employee benefits, including health and retirement plans that are often covered by the federal law, ERISA. Groom attorneys have been focused on ERISA for as long as ERISA has been around, and that's coming up on 50 years. For much of that time, the provision of investment advice has been, with respect to retirement plans, has been governed by the 5-part test, a 1975 regulation. The proposed rulemaking at issue today is another attempt to redesign the regulation and its implementing exemptions. This is the third such attempt since 2010. I personally devoted thousands of hours on advocacy and compliance work back in 2015 through 2018 during the last Department of Labor's proposal and finalization. This was the proposal that was vacated by the Fifth Circuit in 2018. Why is this rulemaking so important? This rulemaking is so important because ERISA is a statute of prohibitions. It starts from a place of no. No actions can be taken without permission. That means no services can be provided and very few sales can occur without complying with the conditions of a prohibited transaction exemption. Failure to comply with an exemption can result in having to disgorge penalties or disgorge profits. It might impose penalties, and it will also impose excise taxation. These are all very serious consequences. Why is this rulemaking so important to you? Although it is framed as protection from junk fees and regulatory arbitrage, the proposal, in my opinion, is at heart the federal DOL's inability to take a win. The 2016 rulemaking truly did shift the retirement industry and the financial professionals that work in it. The rulemaking kicked off, or at least preceded, consumer protection efforts from others like the SEC and from states. These consumer protection efforts have included regulation best interest and the adoption by the states of NIAC's Model 275. Several states have also imposed fiduciary standards on state-regulated financial professionals. The disclosures that retirement investors now receive have become more fulsome. The efforts to mitigate conflicts have also increased. Under these consumer protection efforts, the standards of care require some formulation of providing a recommendation that takes into account the recipient's needs without placing the financial interests of the financial professional first. For a rulemaking that was vacated before it truly took hold, it's pretty remarkable the impact that it has had. Rather than allowing these new efforts to establish and flourish, the DOL has taken direct aim at the states. The DOL is of the belief that regulatory arbitrage occurs where investment advice providers can use more favorable rules in one market to circumvent less favorable rules elsewhere. When they use elsewhere here, they mean avoiding the DOL regulation to be regulated at the state level. The DOL states that state-regulated annuities are covered by state regulations that potentially hold those selling such insurance products to a lower standard. The DOL views Model 275 as lacking because they view it as a suitability standard rather than a fiduciary one. Because the DOL does not believe that the state-adopted standards of insurance regulation are good enough, they feel it justifies federal regulation in this area. The regulation first broadens the definition of fiduciary investment advice to capture most activities by a financial professional when the recipient is a retirement plan participant or IRA. Next, the DOL once again uses its exemptions to impose standards of care upon entities and transaction types that Congress did not. Further, if stating that state standards were too low and imposing standards upon IRAs that Congress admitted wasn't enough, the exemption also reserves an unbelievable amount of discretion to the DOL in a manner that could be business ending. The DOL has proposed to condition exemptive relief upon remaining eligible. Ineligibility is found based upon affiliate convictions, including when a foreign affiliate is convicted, in areas that are completely unrelated to providing investment advice or management. DOL has also reserved for itself the ability to discretionarily revoke eligibility based upon a pattern of behavior, such as the failure to file excise tax returns. Given DOL's stated goal of forcing everybody to use a single exemption, the loss of that single exemption could result in the inability to conduct business with retirement investors for a full 10 years for both small shops and multinational institutions. The fewer providers that are in this space, the less likely it is for consumers to have access to the provider of their choice, and the growing possibility that prices will increase as compliance becomes more complex. In my opinion, providers are willing and able to comply with an appropriate standard of care, but the DOL's vision for an appropriate standard of care tramples upon where other regulators have already recently acted. It imposes compliance costs in the form of disclosures that DOL itself does not believe enhance protection. Confusion over the ability to tout your own services as a sales effort rather than being fiduciary advice has caused many to shy away from advising upon retirement assets, even while advising or managing that same person's non-retirement assets. The rulemaking's scant nod to ERISA's savings clause, which is meant to carve out from federal preemption state laws that regulate insurance, banking, and securities, is inadequate because this rulemaking is intended to push state regulators out of the field because they elected to impose a standard of care that the DOL does not approve of. DOL's bid to, quote unquote, level the playing field has been to set the field beyond the reach of state regulators based on unconvincing worries that no other regulator is able to protect retirement consumers as well as it can. It states that it uniquely among regulators can impose uniform standards for the provision of investment advice to retirement investors. As mentioned in your resolutions that the chair just referenced from earlier this year, that protection goes to such an extreme that it limited its services in the last go-around, so the 2016 go-around. And it may well do so again. Given ERISA's starting point of prohibition, providing a recommendation that is indeed in the consumer's best interest is not good enough. You still need to comply with all the bells and whistles of the exemption conditions. Meeting all those add-ons is costly, and failure with respect to those add-ons can result in the inability to conduct business, even while meeting a best interest standard of care. Forcing so many relationships into DOL's regulatory field is not necessary given the efforts of other regulatory bodies to act in these spaces, including your efforts with Model 275. Usurping your regulatory authority based on no evidence or experience with the newly adopted and implemented Model 275 appears unjustified and like regulation for the sake of regulation, given all the widespread changes that have occurred in the financial services industry in the past decade. Thank you for your time.
Thank you, Ms. Allison, and now we will hear from Mr. Bryan.
Thank you, Mr. Chair, and I appreciate the opportunity to be here before you today. Let me start by agreeing with Ms. Atami with respect to what we felt was an absolutely outrageous and inappropriate attack on one particular insurance product by the White House when the regulation was issued, namely fixed index annuities. We published an editorial several days after that attack criticizing quite vociferously the unfair and frankly flawed attack on fixed index annuities because they are perfectly appropriate and sound products and investment options for retirement investors, frankly benefiting millions of those investors throughout the country. And so I want to make sure that on the record, and we've been consistent with this, we want everyone to understand how we feel about the way the regulation was rolled out, that it was inappropriate, and certainly we believe and support the idea that products like fixed index annuities have an important role to play in the retirement investor marketplace. That being said, there is one aspect of the current regulatory regime that we as an organization have concern about, and that has to do with retirement plans that are sponsored by employers. Let me explain. For 140 million American workers, the gateway to investing in the first place is in the workplace. That's how most Americans save, invest in the market, build wealth, and hopefully generational wealth. As an organization, we have been continuously working to expand coverage of workplace retirement plans because they are the gateway to building that equity and starting to save. American workers are 15 times more likely to save when they're covered by a workplace plan than on their own in an IRA. Retirement plans in the workplace work. Problem is there's still 40% of the American workforce, roughly 65 million American workers, who don't have access to a plan at work. And it's particularly acute and problematic for communities of color, where predominantly many of them work for smaller businesses, family-owned businesses, and the racial wealth gap when it comes to retirement savings remains significant. 50% of Black Americans, 62% of Hispanic Americans have no retirement savings compared to about 35% of white Americans. We believe that gap is absolutely unacceptable. So expanding coverage to workplace plans is critically important. You might be asking yourself, why am I talking about this? And what does this have to do with the fiduciary rule? Well, the one thing that the NAIC model rule doesn't apply to, the one thing that Reg BI, the SEC best interest rule, doesn't apply to, is the advice given to an employer with respect to their workplace retirement plan that they're offering to their employees. And that is why we have a concern with the current regulatory regime. And that is the element of this rule that we think is worth considering. The reason this is so important is because the person, and by the way, this rule with respect to the fact that Reg BI doesn't apply to workplace retirement plans or the model rule is because advice given to a small business owner is considered institutional advice. Even if that small business owner has 2 employees and has no sophistication when it comes to investments. So basically what we're saying is that there is no current regulatory regime when it comes to workplace retirement plans in many cases, and in particular when it comes to the selling of a retirement plan to a small business owner. We, along with many of you in states, have been working very hard to address this coverage problem. There are now 14 states that require employers above a certain size to have some type of workplace plan. We've worked with many of you on that legislation. We just recently worked with Congress to enact numerous provisions to incentivize and make it easier for small businesses to have workplace retirement plans. I think we all share the goal of having some coverage in the workplace so that working Americans can save. The problem is there is no investor protections in many cases for those small business owners, and that's the focus of our emphasis with respect to this rule. So thank you, and I'm happy to answer any questions.
Thank you, sir. And now we will hear from Ms. Walters. Ms. Leah Walters.
Thank you. First, I want to thank NCOIL and CEO Tom Considine for your statement on the DOL proposal. And we agree with you. The proposed rule is unnecessary and burdensome to the many consumers it seeks to protect. And we also agree that it 100% undermines the state-based regulatory system on insurance. And this encroachment by the federal government should not go unnoticed. As you just heard, a lot has happened since 2016. The SEC has a best interest regulation. The NAIC has adopted amendments to Model 275, and 40 states have adopted the NAIC best interest language. And for those who know about NAIC models, and the director is sitting next to me and I'm going to hold her ears, that's not an easy feat in 2 to 3 years, 40 states, and it's growing. We also have 6 states with pending activity, and we think Utah will be number 41 on December 3rd. So we want to thank all of you for the work in your states that you've done getting this accomplished. And you know, it's been a lot of work, and we appreciate all of it. But this federal trend, this federal trend of staff completely ignoring the state-based insurance regulation system should not go unnoticed. This is the second such encroachment in 1 year. In July, there was a tri-agency of the Department of Health and Human Services, DOL, and Treasury. They proposed a rule preempting state authority on short-term limited duration insurance and supplemental products. Both the NCOIL and the NAIC issued letters of opposition on such encroachment, and you know, we agree with you. We think the state-based system is where the regulation of insurance products should continue. We heard a lot from Allison about what the rule itself does, and we believe it's a significant setback for retirement savers. We believe that public policy should provide that all Americans with the option for financial security, and that should happen through choices, not limitations on their financial security. Conflating legitimate retirement costs with junk fees, we believe, was a scare tactic to push regulation that will hurt Americans. The other thing is traditional pensions are no longer the norm. So guaranteed income through annuities lets people create their own pensions, and that's why annuity ownership is up. And just a couple more facts, and then I'll be done and available to answer any questions. The median household income among annuity owners is $76,000 a year. The median household income is $63,000 a year. So you see who's buying annuities, middle income. And fiduciaries generally or typically charge an ongoing fees and impose account minimums that moderate income savers just cannot afford. So we think this would be a huge hit to the middle market. Let's see, oh, sorry. So again, we just want to thank you and COIL and the NAIC for your leadership on this. We think you're already protecting consumers against conflicts of interest. These 40 states represent 76% of U.S. consumers with this enhanced best interest care, and we think that that's exactly where it belongs in the states. So thank you for all that you do, and I'm happy to answer any questions.
Thank you, Ms. Leah Walters, and just want you to know where I come from in South Carolina. When you do something for the first time, we say it's your debut. So it is my understanding out of your 20 years there on your job, this is your first time at NCOIL, so today was your debut, baby.
Well, thank you.
We love having fun. Thank you, everyone. Now the chair will entertain from those colleagues of mine around the table if you have a question or comment. Okay. Y'all did a good job. Thank you. We really appreciate you being here today, and we'll all be sure to continue monitoring the DOL's next step in this area. Last on our agenda, it appears that y'all must have something else to do today because nobody's got questions or comments. Somebody said at 4:30 y'all got something to do, so we're going to get you right on out of the way. If you're having a party, please let us know so that we can attend. Last on the agenda is a discussion on the activities of the ENAC's Securities Valuation Office, also called the SVO. This discussion deals with a proposal from the ENAC's SVO that, generally speaking, would provide them with the authority to overrule the determination of rating agencies that rate certain types of securities. The proposal has generated a significant amount of controversy. There are a slew of questions about potential issues with the proposal that can be said to fall into three buckets. Number one, due process. Number two, unintended consequences. Number three, misguided financial incentives for the SVO. So, with that being said, these are just for your background. 3 little bullet points for your background. First, the whole nature of appeals seems vague. Okay. All right. Okay. My second boss says we're running a little bit out of town. I think he's invited to one of those parties. All right. All right, this has garnered our attention at the federal level. A letter was sent to the ENAC by several U.S. House members raising concerns. You can see that letter on the website and the app, along with ENAC's response. I'll stop there, as I don't want to take up any more time from our speakers, who I think they have a big reception or something going on, because they are smiling like mad. Y'all cannot see this, but I see them smiling. But if you don't invite me, I'll tell you what. Joining us today is the Honorable Beth, Director of the Rhode Island Department of Business Regulation, and Ms. Caitlin, Senior Managing Director for Business Development at Kroll Bond Rating Agency, and the lady that has her debut, Ms. Walters of the ACLI. And I must say, Ms. Walters, you're really making the most of your first ever in-call meeting. Here we are. All right, come on, Director Dewey, talk to us.
Thank you so much, Mr. Chair. I will try to get through this pretty quickly, although it is a very complicated subject. So what is the issue? The issue is that insurers are investing in newer products, not your typical bonds. They're more, they're not as easily understood as we have seen in the past. So the NAIC had a number of working groups under their Financial Condition Committee looking at various issues with these type of investments. As you know, one of our main focuses, if not our main focus as state insurance regulators, is the solvency of companies. And we have to understand what they are investing in order to have a understanding of whether or not the companies are solvent. So we started hearing comments, as I believe you did as well, from various people involved in investments and insurers, that it seemed like our approach was scattershot, maybe not coordinated. And so what we did was we put out what we are calling the Framework for Insurer Investments, which you have on the screen here. What we did was draft a framework that I'm going to go through the 7 points of our initial draft. And we hope that each of these points shows that these issues are being coordinated at the commissioner level. They are not being directed by NAIC staff. The comments that we are hearing are being addressed. For instance, due process, I think you're going to see even more when we come to our next version of the draft on various ways to give due process to insurers who have these investments. But let me run through, if I could, what that framework is going to look like. The purpose is, it's not an intent to compete with credit rating providers or to become a credit rating provider. Our intent is to understand the ratings and establish a clear procedure on how we would adjust a rating on a particular investment if we believe that that rating was not properly assessing risk. So what we're trying to get to is the appropriate financial charge based on the risk of the investment. We are committed to a clear procedure with levels of appeals, and we are committed to adding levels of appeal that are not currently in our process. Our intent is to continue to rely on credit rating providers, but to make sure that that reliance is well informed. A number of people within state insurance departments have called our current reliance on credit rating providers blind reliance. And from a financial regulator's point of view, that is scary. We want to understand what the investment is, and we want to have the appropriate charge for that investment. So the first proposal is to reduce or eliminate blind reliance on credit rating providers, but retain overall utilization of those providers with the implementation of a due diligence framework. That framework has yet to be drafted. We do have some investment professionals within the states that are going to draft procedures, and that will be out for public comment. I actually included at the very end here, the last bullet, a quote from the framework, which says, "It is inefficient and impractical for the Securities Valuation Office to effectively replicate the capabilities of credit rating providers on a large scale, and would not provide incremental benefit if the output is substantially similar. Rather, the SVO should focus primarily on holistic due diligence around credit rating provider usage." What that means is we intend to continue to rely on credit rating providers unless we see some indicia that that particular investment is getting an inappropriate charge in our financial framework. The second proposal is to retain the ability within the Securities Valuation Office to provide individual credit assessment and utilize regulatory discretion when needed, again, under well-documented and governed parameters. This is a backstop. So most credit ratings are going to be accepted. The newer and more exotic, if that's the right word, and it probably isn't the right word, those are the ones that we're going to be focusing on, the ones that we feel like we're not getting the right charge for. We're not going to be focusing on all of them. I've also heard some criticism that the SVO in and of itself wants to create itself as a competitor to credit rating providers. And I do want all of you to know the SVO is part of the NAIC. The people that work there are NAIC employees. What they do and how they do it is directed by the commissioners. So it doesn't matter how much money comes in, it doesn't matter. They don't have the free discretion to spend whatever they want or add FTEs or anything like that. That all has to be approved by the commissioners. There is no intent by the commissioners to compete with CRPs. What we use the Securities Valuation Office for is to inform commissioners on very complicated investments and how we should look at those investments in evaluating the financial solvency of an insurance company. The third proposal is to enhance the SVO risk analysis capabilities. So this is to assist commissioners on understanding risk analysis. It's not directly associated with any credit rating provider, but this would cost money, and the NAIC would have to approve the money in order for us to do this. But it's something that we think could be very valuable to individual states in doing their own analysis. The fourth proposal is to enhance the structured asset modeling capabilities, focusing less on individual designation production and more on credit rating provider due diligence and validation. Again, we're going to have to draft procedures on this, but what we're trying to do is set up procedures for credit rating providers so that we can have more faith in the ratings that we receive from them. The fifth proposal is to build out a broad policy advisory function at the Securities Valuation Office that can consider and recommend future policy changes to regulators. So we are not investment experts, we are insurance regulators, but we do need to understand and be able to take into account the securities that our insurers are investing in. The sixth proposal is an investment working group under the E Committee. We currently have something called oh my God, I forget what it's called. The VOG, yeah, so Valuation of Securities Task Force. The proposal is to make a smaller group very, very specifically focused on investments to advise the commissioners on various policies. And the final proposal, and I am going through these very quickly, but I think you'll have the slides available to you, but I know you don't have a lot of time, and I want to let Caitlin and others speak, is to rename the SVO and the Valuation of Securities Task Force to better recognize the responsibilities of the groups. We also have an issue with the Valuation of Securities Task Force in that there's just too many members. I'm sure you've all been members of committees. When there's so many people, you can't get anything done. So we're looking at the committees and the task force we have in this area to see if reduction in size might assist us in getting more done. So the conclusion is that these proposals are designed to provide regulators with the tools that we need to properly value investments. The goal is equal capital for equal risk, As financial regulators, we're attempting to assess the appropriate capital and avoid regulatory arbitrage. There is no attempt to compete with CRPs. We are the recipients of the ratings, and we're evaluating them for our own use, not putting them out for somebody else's use. The NAIC has established a public process to consider this, so the framework is out for comment. We've received comment from, I believe, 17 different carriers. I would, by the way, strongly suggest that anybody who is interested in this file comment, either orally or written. It makes it very difficult when we hear comment outside of what we have in the process. It's very difficult to address those comments if the people who are interested don't file comments. We will have a meeting at the NAIC meeting in Orlando where each of the 17 that have filed written comments will be allowed to supplement those comments orally. We will then take back all of the comments and come up with a second version of the framework, hopefully addressing most of the issues that commenters bring up. So anyway, that is what we're doing, and we're happy to continue to speak with anyone in NQUIL or anybody else about what we're doing or how best to achieve it. Thank you.
Thank you, Ms. Director. Appreciate you being here. Well, the youngest person on the panel is Ms. Caitlin, and I'm going to say to her, take your time, baby, don't rush.
Thank you, Mr. Chair. And thank you, Superintendent Dwyer, and thank you to NCOIL for having me. I'm happy to give the credit rating agency perspective based on some of the work streams going on within the NAIC. For those of you that aren't familiar, Kroll Bond Rating Agency was founded in 2010. We have over 500 employees, over 68,000 ratings, representing over $3.3 trillion in debt issuance. So we are the largest post-crisis founded rating agency, and we rate all asset classes. We are a registered NRSRO in all asset classes, and we'll talk about that in a little bit. But what I do want to start off by saying is we were very happy to see the E-Committee framework that was released before the summer national meeting. We think there's a lot of really interesting and helpful guideposts in that framework. And most importantly, I think it's important to say we are very supportive of additional rating agency diligence. We're happy to talk about our process, and speaking from KBRA's perspective, of course, we're happy to talk about our process, our methodologies, how our teams arrive at certain ratings. We're happy to do case studies on certain transactions and talk about asset classes. We think rating agencies broadly actually are very well positioned to opine on credit, given that is our sole reason for existing. And we as rating agencies, and again, speaking specifically for KBRA, we work really hard at cultivating sector expertise. And we really believe we are the experts in particular in certain asset classes that may potentially be more challenging and take a little bit longer to understand. But we think it's really important to staff our credit analysts with the right people to dive into those credits. And we don't take that lightly. It can take us months to turn around a rating and come to a rating that we think is the appropriate rating for that security. I'm just speaking from experience. I'm an aircraft finance lawyer by trade. Super strange, but they were still being financed in the GFC, so here I am. I was initially hired by KBRA to actually rate aircraft finance transactions. And I was able to build a team and pass along knowledge that we think is really helpful in the ratings that we have outstanding in that asset class. We really understand collateral, we really understand structure, and we think it's really helpful to the market and the write-ups we provide to insurance companies that are purchasing that kind of paper. That's just one example. But I do believe we also believe that you don't really want your podiatrist doing brain surgery, right? So we have subject matter expertise in each asset class that we do. I think in contrast to the SVO, and I think in what Superintendent Dwyer was saying, they are a very helpful organization and a helpful staff to the Valuation of Securities Task Force. But they are tasked with reviewing a great many securities. we have the staff and expertise, we think, to sort of be best in class in credit ratings. So we think we're happy to shed light on how we do that, and we look forward to engaging in further dialogue. And in fact, the Valuation Securities Task Force passed along a list of, the numbers escaping me, 20-odd questions to each CRP about our processes, about our regulations, about our methodologies, and we did provide responses to those and very much look forward to dialoguing with regulators on those. We think that's going to shed a lot of light on how diligent these processes are and how much the insurance companies actually rely on the write-ups that we do. And in contrast, not only do we provide the write-up in conjunction with the rating itself, we also do extensive research across asset classes where we believe banks in particular, there's a void. So sector expertise is helpful. But I do just want to take a minute or two to focus on the federal regulation over NRSROs. We are an approved rating agency. We are regulated by the SEC. We are also regulated in Europe by ESMA and the FCA. And those regulations, and in particular US federal regulation, require us to be extremely transparent in what we're doing. It requires us to have published methodologies. It requires us to back test when we're changing methodologies. It requires us to say how many ratings would be impacted when we make those changes. I think things like that are really helpful, particularly when it comes to the NAIC. I think S&P, for example, just produced its insurance rating, RBC rating methodologies today. It was required to list which companies would be impacted by or potentially impacted by that methodology. That kind of transparency is really helpful. And I think as we start working through the discretionary proposal that Mr. Chair spoke about at the beginning, we think it's really important that transparency exists because it is required by rating agencies, and we think that we can be very helpful in that process. And as Commissioner Dwyer said, the discretionary proposal, it was re-released, and it'll be seemingly on the agenda at the national meeting. The whole shebang, but the vast majority of the agenda. And as was alluded to at the beginning by the chair as well, it garnered a significant amount of attention, the initial draft. My read of the secondary draft and some insurance inbounds I received is that there are certain additional transparencies built in. But I very much look forward to understanding a little bit better what the SVO is required to bring in front of regulators, particularly state regulators, where you have insurance companies across states. How's that going to be worked out? And very much looking forward to understanding the controls that the commissioners are looking to put in place in light of the E-committee framework. But I think we'll be hearing a lot more of that after the national meeting in December. And maybe, I know where people have cocktails, so I do want to be respectful. So maybe with that, I'll just say thanks again for having me, and really I'm happy to take any questions. If anybody has questions on how CRPs are regulated, what we do, how we do it, I'm happy to talk.
Well, thank you, Ms. Caitlin, and we need to talk about that aircraft. Yeah. I'll talk to you after this about that aircraft.
Okay.
Yeah. I want to get some info on that aircraft. Make sure my pilot is not taking advantage of me.
You got it.
Now we will hear from Ms. Walters.
All right, and if my debut at NCOIL is successful, I'll be done in 30 seconds here. ACLI and its member companies appreciate and support this new holistic approach that the NAIC is looking into. As we know, the regulation of insurance investments continues to evolve daily. So it makes sense for this coordinated approach. While each of the projects are led by knowledgeable subject matters and there's some overlap in membership between the working groups, we think it might also make sense to maybe create a more smaller group of knowledgeable regulators that have a clear sight into all of the groups so that they can see the big picture and the interconnected projects and perhaps could provide an additional layer of leadership and guidance if necessary. But with that, I conclude my comments. Thank you.
You did a minute, you were good.
All righty.
Now we have some questions for the panel. Senator Lana, followed by Representative Overson.
Thank you very much. Thank you for your presentation today, and this is an extraordinarily important issue, but just with the directors, Director Dwyer, I have some generalized questions. You were talking about how there's a blind reliance. They weren't appropriately assessing risk. You wanted people to be well informed. Who considers the risk inappropriate, and based on what factor? What are you looking at to consider it appropriate? Because they have measurable, quantifiable success rates, and you weren't referring to those.
So this is only on some, by the way. So the vast majority of ratings are accepted by the NAIC and a charge is given. There's various indicia on some, and it's usually private credit. It won't be, something that you'd use, it's not something you or I would buy. This is private credit. One of the things we're going to put into our procedures is what indicia it would be that would lead us to consider to take one step further and look closer at the investment. So some of the things I've heard, and I do not obviously day-to-day look at investments myself, but some of the things I've heard are a credit rated at A, where the underlying assets might be a C, and you wonder why the A is given. So you look a little further into, was that appropriate valuation? That's the kind of thing we're talking about.
Are you seeing, if I might continue to
Sure.
follow up, are you seeing insolvency such that you feel like you need to do this?
So we're not seeing insolvency, but our job is to make sure that the insolvencies don't occur. The new synthetic, and I don't know if synthetic's the right word, but the newer investments are starting to come into the market. They are not a huge percentage of the market yet, but we don't usually wait until there is an insolvency to do something that we're concerned about.
So I understand what you're saying, but it sounds like you have a regulator overseeing something that's going to be, we're going to agree with you as long as we agree with you, and then we're going to tell you it's not correct and you're going to have to go back, and that's going to be a pretty chilling effect on our rating agencies in how they're going to be able to approach the rating, what they're going to consider, and what remedies they might have. So I have concerns about NAIC and the regulator organization being the one that makes the determination as whether or not these rating factors are accurate. It doesn't seem like it's going to be an independent approach. I mean, it's basically as long as you say what we think, then we agree and you're good. But if we disagree, there's going to be a major problem.
So that's kind of what we do every day. So you might have an insurer file a reserve with you, and this isn't having anything to do with investments, but you'll file a reserve with us, our domestic companies, and we will take a look at it with a consulting actuary or an actuary that's on staff and say, we don't agree with you. And we go back and forth with the insurer. That would kind of be the same thing here, except that you have the involvement of credit rating providers, which you wouldn't in a reserve type situation.
It is an expansion of what it is that you do. It's not what you do every day. This is an expansion. Am I wrong?
No, it's not an expansion. Every day we do look at the investments of insurers and give them an appropriate charge. The issue is the investments are changing. So these are newer investments. They're not, I don't know, buying a corporate bond. If you buy a corporate bond, it's pretty easy. You bought the bond is rated A or B. We give an appropriate charge for this. These are newer investments. They're not the corporate bond. They are more complicated, and we feel we need to understand that the rating that's given and why it's given to give the appropriate charge. We also have an issue between companies. So if there are certain companies investing in these newer investments, and they're getting an inappropriate charge for that, there's a competitive advantage over companies that are still investing in bonds. So we're also looking at that. We have to make sure that whatever financial charge we're giving is the appropriate charge for that investment.
All right, well, thank you very kindly. They're telling me my time is almost up, y'all. Y'all got me pressed here. Rep. Overson?
Thank you, Mr. Chairman. I have additionally have a few questions. So my understanding is that you have these NRSROs, which are all regulated by the SEC. The private sector is essentially already fulfilling this responsibility. But now we have the organization that is not regulated by the SEC, which is responsible for taking those recommendations and basically taking action with the insurance companies doing business in their states. And sort of, I'm going to take your business from you and I'm going to do it myself. My question is, are you going to charge? Does the SRO charge for this, or SVO charge for these services that they're providing?
So they do charge for some services, and we are going to look at what they're charging and how they charge. But we are the customer. So when a bond is rated by and we call them NRS, she's in the day-to-day, NRSRO, which is what they call them with the SEC. We actually call them credit rating providers, which is why I kept saying CRP. Okay, thank you. We are the customer of that. So we're looking at the solvency of the insurance company. The rating organization is rating that bond, and then we're looking at that rating and making sure that we agree with it. If right now, a lot of what we do is simply blind reliance on that SEC-regulated provider. The problem is the SEC is not responsible for the solvency of insurance companies. If we see an investment that we do not feel is getting the appropriate charge, that can affect the insolvency of the insurance company, which is what our responsibility is.
I mean, it just seems to me like this is an unmitigated, terrible conflict of interest for the NAIC to get into this business. And then I could see in a very short period of time that essentially this becomes the only company doing this business because the NAIC stops using everybody else and essentially says, we're just going to do this in-house. And oh, by the way, we're making a lot of money by doing it. I mean, I really have a bad feeling about this. And I hope that you all will go back to the drawing board on multiple proposals here. I have serious questions about the appeals process, the lack of transparency, the fact that essentially, in order to take a disagreement, if you're an insurance company and you disagree with the SVO, you're essentially appealing to the umpire that threw you out of the game. There is no alternative mechanism for dispute resolution. And if you come in heavy-handed as an insurance company because you object to the ratings, now you're not only picking a fight with the SVO, you're picking a fight with the NAIC, who essentially holds all the cards in your future ability to do business. I think this is an unbelievably bad conflict of interest, and I can assure you that we are going to continue to stay very aggressively engaged with you on this if y'all continue down this path to make sure that we're not doing irreparable damage to the free market in this process by essentially reducing the number of NSRSOs down to one, which is SVO.
I can tell you, Senator, that is absolutely not the intent of the commissioners at all. We have absolutely no intent to replace credit rating providers. In fact, in order for us to do our own ratings of all of the investments of insurance companies, we'd have to be larger than S&P, and we have no intent to do that.
I want to thank you for clearing that up for all of us and letting them know that that's not your intention. Y'all, I got 2 minutes left, and I need to hear from Senator Hackett, followed by Senator George.
Tom, we rarely disagree, but I agree with you profusely. And here's why I do that, is that, I like the rating agencies, but the rating agencies aren't perfect. And I'll give you an example, Tom. Look at mortgage-backed bonds. She'll tell you, the rating agencies in 08 and 09, or probably 08, they were rated a lot better than they should have been rated, but they were rated based on the the details and the data of risk that they were given. And so I don't mind that because our Department of Insurance has, we have to make sure that companies, we have to look at them even stronger than in addition to the rating agencies. So they're going to listen to the rating agencies, but they're going to make the rating agencies really, do that, because that was the question I asked Kroll. I mean, how did you rate the mortgage-backed bonds in '09? Because I know how Moody rated them and S&P rated them, so how did you rate them?
So that's easy for me. We didn't. We were founded in 2010, so we weren't.
No, I'm not criticizing. That's probably why they started, because of the criticism.
That's exactly right.
at Moody's.
That's
Isn't-
exactly
am I
right.
right? Yeah.
That's-
and
we
so-
are an
so, Tom, I
alternative.
don't mind that
So,
we
Bob,
have
do it-
another look at it. I really
Do it
don't.
at cost then. Don't turn it into a profit center. If you're turning it into a profit center, then it becomes a monopoly. Do it at cost, but that's not what I'm hearing here.
All right, ladies and gentlemen, I want to say thank you for your intent today. And I am so sorry that I have to close this meeting, but my time is up, and y'all know how I am about time. Just thank you all. Senator George, I ask that you talk to them about it. But ladies, thank you. Let's give the panel a round of applause and thank. Do we have a motion to adjourn?
I think you do it right.
George does not motion to adjourn.
Do we have a motion to adjourn?
Yeah, Westfall.
So moved second. We're now adjourned. Bylaws will be in 2 minutes.
Yep.